Thing number one, Gary, another hot CPI.
Yeah, this is the news that we keep reporting on. So last Wednesday, we got the October CPI, that stands for Consumer Price Index. And generally, when people talk about inflation, this is the index that we're referring to. When someone says inflation is up 2% or 3% or 10%, it's usually the CPI, the Consumer Price Index they're talking about. Last month, we had an overall increase of 2.6% for the year, which was above last month's 2.4%. And the core number, the core CPI, which excludes food and energy, was up 3.3%. And up 0.3% from the prior month. That annualizes to 3.7%. For people who are feeling a little overwhelmed with all the numbers, we're going to shortcut it for you and tell you these numbers are far above the targets. The target is 2%. By the way, that target is 2% too high. The Fed's mandate is stable prices. That means 0% inflation. They like 2%. Either way, we are way above that. The core annualizing to 3.7% is not even close. And then the producer price index, the PPI, that also came in high. And the reason this matters is because the PPI leads the CPI. And here's the reason. If you're a producer and your cost of materials goes up, your cost of labor goes up, your costs are higher, well, guess what? You raise your prices, and that makes its way into the consumer price index, a few months, a quarter or two down the road. So not only a hot CPI, but we had a high PPI, which means more CPI inflation down the road. This is not what the Fed wanted to see, Rob.
Gary, you talked about printing dollars to pay the interest on the dollars we already printed. Definition of a Ponzi scheme, as you mentioned in the takeaway. You also said, Gary, that raising the rates to the level that they need to, higher interest expense, further increase in the money supply. You talk about them being stuck. What do they do? How do they do it? And I know I've asked this question before on the five things.
Well, so Rob, I had the great opportunity to do the shares for beginners or stocks for beginners podcast last week with Phil Muscatello, one of my favorite shows to do. And Phil asked me the exact same question. And what can the Fed do? Well, nothing. And here's the reason. The reason is if the Fed keeps lowering rates, we're going to have higher inflation. That's just the way this works. And by the way, I'm going to point out that if you look at episodes of this show from months ago, we said this is exactly what was going to happen. We said the Fed was lowering rates too soon. They were causing the Arthur Burns problem. Arthur Burns was the Fed chair back in the 1970s who reduced the Fed funds rate when inflation was on the way down, but not under control. And that led to the roaring, incredible, huge economy crushing inflation of the mid to late 1970s. And, we warned this is where we were headed. We said the Fed was cutting too soon and that if they did, which they did, they cut in both September and November 2 weeks ago. We said they were going to regret it because they were going to get more inflation. That's where we are. Now, the other side of that is, okay, well, what if the Fed increases the Fed funds rate? Well, guess what? We've got $36 trillion of on-balance sheet debt. And an increase in the Fed funds rate means a higher interest expense. Now, where we are on that is just a couple of years ago. The interest expense of the United States was about $600 billion. Right now, it is more than $1 trillion. And if we look at it on a run rate basis, next year will be somewhere around $1.5, $1.6 trillion. That's a lot of money. If the Fed were to raise rates, we would increase the interest expense. And because Congress is in a deficit situation, the only thing they can do is print more dollars. That creates more inflation. So when I say the Fed is stuck, this is what I'm saying. And so the question is, what can they do? And, the example that I gave Phil is, think about it this way. Imagine a football game, Rob. You have the ball on your own 20-yard line. You have a minute left, call it 90 seconds left, and you're down by 7 points, right? Congress, in this case, is your quarterback. Your Federal Reserve is the kicker on the sideline. Is the kicker on the team? Yeah. Is he in the stadium? Sure. Is he warming up and kicking the ball in the net? Absolutely. But Rob, Are you putting the kicker in the game? And if you do, can the kicker actually impact the outcome? You tell me.
Now we're talking my language, Gary.
Right. The
And
answer
the
is
answer is no.
right, right. Because the Fed or your kicker, they can get you 3 points. You need seven.
Right.
Right. So
Right.
there's my clever
I
example for
like
the
that.
week. Yeah. If you think it's not clever, give it a thumbs down, put it in the comments that I suck, don't care. But the Fed is the kicker in this situation. They're on the sidelines. The only thing that can be done to fix this situation is Congress needs to cut spending. We've got some really good people on that, starting
Mhm.
the Doge, the Department of what is it, Government Efficiency.
Government efficiency. That's
Yeah,
right.
and we'll get to that later in this episode. Stay tuned.